So today we're going to talk a bit about the weather and what's going on with the U.S. soybean crop and how that's going to impact or potentially impact soybean oil production and soybean oil prices. And then we will go through our usual roundup of what's going on in biofuel or biomass-based diesel margins. All right, so it's been relatively dry over the last couple of months in the Corn Belt, and it looks like it's going to remain kind of dry. And so what we've seen is a bit of a bounce in soybean prices and soybean oil prices. However, it's still really early in the marketing year and in the growing season. And so there's a lot of time for the crop to recover. And remember that it's always kind of good to stress soybean plants a little bit so that they don't focus a lot of their energy on growing big, pretty leaves and having a nice big canopy, but instead turn their focus towards producing seeds and filling those seeds. Now, it's early to stress the crop. This is probably not the ideal time. However, conversely, the crop is just emerging, and so moisture requirements aren't that great. And if there were a time for it to be dry, this is probably it. What we are planting progress continues to advance ahead of the 5-year average. So from that perspective, the crop has as good a chance as it possibly can. Given the dryness, though, I would expect that probably what you'll see is in the June report, it's unusual for USDA to make a change to its production forecast in June. And I'm not sure that it's been dry enough or the crop is far enough along for them to do it this year. However, if conditions remain the same through the end of June, which is a possibility, then it might be dry enough that USDA would cut their crop. If you look at the planting progress for corn, that implies something about the change in corn acreage and soybean acreage from the Prospective Plantings report. This year, we expect corn planting to finish by next week, essentially, which is the average time that farmers finish. And so the changes that are implied by that date are basically statistically insignificant. However, if you look back at the data, actually what happens is there's a couple of big reductions and a couple of big increases that kind of offset each other. So while the implied change for both corn and soybeans is relatively minor, history suggests that that's not necessarily the case. Now, this year, given the pace that we've seen for planting and in the early growing conditions, I would expect that you probably will see acreage that is at or above where prospective plantings were, just because farmers like to plant as much as they can, and if the weather allows them to plant, they will plant fence row to fence row. And so I think while the statistical model would say that there's not much chance for a change, or that the change would be relatively minor, it could be that there's a bigger change than that suggests. Okay, so what is driving the dryness and how long might that last? So there is a weather indicator that's a bit like La Nina and El Nino, in that it takes into account the sea surface temperatures, except instead of at sort of the equatorial Pacific, this is a little further north, kind of off the west coast of the US, just south of Alaska. This index also takes into account sort of the pressure, the 500 millibar pressure in that same area. And it's been relatively negative, which tends to increase rainfall in the Western United States, which they've had a lot of. But then it also tends to mean that in the middle of the US, you get a ridge, and the ridge restricts rainfall over the Corn Belt and it also tends to result in warmer than normal temperatures. And all of that has kind of played out just according to the way that you would expect it, given where the PDO values are currently. Now, our meteorologist expects that the PDO could improve. He's been saying that for, I think, since last fall, kind of. And if you look at sort of the times that PDO is negative or positive, it can go on for an extended period of time. So there is some chance that that the PDO will remain negative, and that will tend to restrict rainfall in the Corn Belt this summer. However, I think that even if you look at the forecast maps right now, and they will change dramatically between now and in the middle of July as summer really gets into high gear as the sun moves further north. But if you look at the weather maps right now, the ridge isn't really that strong, and it tends to get broken down at least near the end of the forecast period. As the weather models go through the forecast period, they rely less and less on initial conditions and more on climatology. So part of that breakdown is just a shift from these are the initial conditions to climatology. And it doesn't necessarily, that's why we don't have tons of confidence in like the 15-day forecast and in what temperatures and rainfall are going to be. However, that tendency from a climatological perspective suggests that the tendency is for rain to develop in the Corn Belt during the summer. There's a reason that the Corn Belt is the Corn Belt, and it's because you tend to get rain and you have good soil there. And so it's not quite as, I think the best weather in the world for growing soybeans is generally kind of in Brazil. And despite the last couple of years, it's very hard to bet against the weather in Brazil. It's a little easier to bet against the weather in the US Corn Belt. However, I think that I don't know, we'll see. In a month, I might be all 100% bullish and on here talking about $20 soybeans and $1 soybean oil. But right now, I tend to think that we probably will get kind of a reversion to the mean, maybe not in June, but in July. In the meantime, what we've seen is kind of a short covering rally because of the concerns about weather, and that is going to help support both soybean and soybean oil prices in the short term. But whether the weather pattern continues into July will tell us a lot about what soybean prices are going to look like over the next sort of 9 months, kind of. So this is just a look at the change in soil moisture in the Midwest from the beginning of April to yesterday. And you can see the impact of the PDO. A little surprised that it's as dry as it is in California. But most of the rainfall recently has kind of been focused in the sort of classical winter wheat areas. And this year's winter wheat crop condition ratings have improved recently, but still remain close to the lower end of the 5-year range. And there's talk of significant abandonment of the wheat crop. And if that were to occur, you could get a boost in soybean acres in some of the traditional wheat states. The last expansion that we saw in soybean acres really kind of occurred a lot in those states where farmers stopped growing wheat essentially and started to grow soybeans. So they're familiar with growing soybeans, and the wheat crop, even though conditions are improving and the rainfall has probably helped, the winter wheat crop is a lot of it is mostly headed, and so it's effectively almost made or almost mature, and so rainfall at this point and going forward does little to help yields, but what it does do is it lowers protein values, and wheat. I'm not a great wheat analyst, but wheat values are directly correlated with protein values. And so to the extent that we could see sort of a significant change from the prospective plantings, I think that there's a better chance that that this has an impact, this abandonment and then planting soybeans idea has an impact than necessarily the pace at which farmers planted corn this year, at least from a statistical perspective. Again, farmers like to plant, and given the conditions this year, they are going to be able to have planted as much as they wanted to. The one thing that I would also note just here is just sort of what I wrote on the slide. We've gotten 4.5 inches of rainfall over the last 2 months, which is about 56% of the average. And if you think of the average for the Midwest, it's about an inch a week during the summer. And so if we only get 1 3/4 inches over the next couple of weeks, that'll be slightly short, but not as short, I think, as we have been over the past couple of months. Now, this is just the current soil moisture anomaly. The last one was a change, but you can see it's really dry in large portions of Iowa and Nebraska and Missouri, and that is the heart of the soybean belt for sure. And so they're going to need timely rainfall to keep the crop going and get it to the point where it can survive until we get rainfall, or I suppose don't get rainfall in the second half of August and early September, when the plants start to fill pods. On Monday, USDA came out with an initial crop condition estimate for the soybean crop, and it came in at 62% of the crop was rated good or excellent. That sounds relatively good. That's almost 2/3 of the crop rated good or excellent. But there's a couple things to think about when you think about these crop condition ratings. One is that early in the season, a lot of plants look good. They come up out of the ground. Again, they don't require a lot of soil moisture. And so it's a little hard to get really bad ratings, and that's reflected in the 5-year average. So 62% is actually below the 5-year average, and certainly below the last couple of years. Going forward, I think it will be key. So typically you see kind of a decline, and if we get down into if we remain sort of at the lower end of the 5-year range, going forward, 50% of the crop being good or excellent, when it's big enough to actually sort of be judged, doesn't imply that we're going to hit trendline yields, and that will have a significant impact on our balance sheet. Now, much like we've done in Canada the last couple of years, soybeans in the US, it's going to get to the point where we want to crush so much that it's going to be a choice. If the crop is short, it's going to be a choice between exporting and crushing. Given the record production in Brazil, we are obviously going to favor holding our crush forecast pretty steady, and any reductions in production we probably are going to use to reduce our export forecast. The spread between Brazil and the US is narrowed, but it still is significant. I did a presentation last week. I think that was the last time I looked at it. And I think at that point, US beans out of the Gulf to China were $60 a ton cheaper from Brazil, and out of the Gulf to Europe were $68 a ton cheaper from Brazil. So it's not, this is the height of Brazil's export season, and so they will always kind of have a relative advantage at this time of the year. But I think that, again, like I talked about a couple of weeks ago, given the trends in production, the US soybean crop is going to become more and more of a domestically consumed crop as crush grows. And I don't think that in the short term, the next 3 to 5 years, we'll see as significant a drop off in US soybean exports as we've seen in soybean oil. But that same kind of trend, I think, is going to apply, unless we just start to grow bumper crop after bumper crop and we build our stocks to 500 million bushels or 900 million bushels or whatever. And then in that case, we probably will be a little bit more competitive and will have the soybeans to export. The other side of it is China and their demand. Obviously, they are the most important country in terms of soybean imports, and their demand hasn't been as strong as I expected this year at all. And so I would expect that will recover at some point. I still think that their shift from their shift to a modern hog farming industry will help support their soybean import demand, if not this year or next year, certainly kind of over the next 3 to 5 years. I would expect them to be back and their demand to be growing pretty substantially. Last week we got USDA's monthly fats and oils report, and as you can see, crush came in at 187 million bushels, and that was a little bit, the difference between that and NOPA was a little bit bigger this month than it has been in recent months, and so it was a little bit above our forecast or our estimate, and as a result, then soybean oil production was a little above, and stocks were also a little above. We expect crush to remain relatively strong through the balance of the summer, in particular because of soybean meal demand, which after a month of sort of weaker than last year, came back in April and was well above last year and above where we were in March. Given where oil share is currently, crushers are definitely crushing for meal and kind of have this situation where meal demand has been strong and soybean oil demand from renewable diesel producers hasn't quite been as strong as expected. And so they can still crush for meal and produce enough soybean oil to meet the needs of renewable diesel producers without having to crush for oil and then kind of figure out what to do with the meal. And as long as the strong demand for meal continues, then that's probably going to remain the case. There was an article that I read last week that was talking about the spread between pork prices and steak prices or beef prices, and that it had become sort of historically wide. Cattle prices are really, really high right now, and pork prices have been relatively depressed. And the article was basically saying that just when the spread gets that wide, consumer behavior starts to narrow it again at the retail level, because they start to switch from buying steak to buying pork. And so if that's the case, or chicken too, if that's the case, then meal demand could be as strong or stronger than we expect. Avian flu wasn't really a problem this spring, like it's certainly not as bad as it was last year. And so we've seen egg prices fall, and while the chickens that lay eggs aren't the chickens that we eat, they still are kind of an indication of how the flock is doing in terms of coming back from avian flu last fall. And so meal demand is likely to remain pretty strong through the end of the marketing year. And again, that'll just provide crushers with that sort of comfort level of crushing to meal demand and then selling the oil, as opposed to what ultimately they're going to have to do, which is crush for oil and then try and figure out what to do with the meal. Last week, we also got the EIA's monthly feedstock report, and you can see that the daily average use of soybean oil and biodiesel production was down just a touch from February, and down relatively significantly from last year. We expect that biodiesel feedstock demand probably continues to weaken a little bit. However, it goes back to this this idea of how much is everybody going to produce, and what I wrote a lot about in the biodiesel article this week was the relative performance of biodiesel margins and renewable diesel margins over the past year, and how biodiesel margins have really outperformed renewable diesel margins. And that makes sort of the long anticipated decline in biodiesel capacity just seem that much further out. And so while we do have cuts through the end of the year and then more aggressive cuts in beginning next year, with each passing month's data, it seems more and more likely, and with each week's margin calculation, it seems more and more likely that biodiesel capacity is going to remain, at least for the foreseeable future, I guess, at least into through the end of 2023. Now, the switch to the IRA tax credit will have an impact, and will have an impact on the feedstock mix as well. However, there still is only so much volume of fats and greases that are available to biofuel producers to use as feedstocks. And so soybean is going to continue to play, or soybean oil is going to continue to play a significant role in the feedstock mix, even after the introduction of the IRA credit. Renewable diesel. So I showed this chart a while ago, and you could have drawn a kind of almost a straight line between February and April, and you can see that that was a pretty significant miss. And it kind of throws into doubt, what does the rest of the summer look like? And I was actually talking to Joao just before the presentation while we were getting ready. And what we're going to have to do is we're going to have to go back through our renewable diesel feedstock demand forecast and modify it a little bit, because the prediction of up and to the right for this one just doesn't seem to bear out. I had big hopes for March, and there were some things that happened in March that may make it an anomaly. But I think what it really does suggest is sort of this rocket ship up might be a little bit too optimistic on renewable diesel production and feedstock demand. All of that said, the expansion in renewable diesel capacity does imply that that production is going to rise relatively significantly through the balance of 2023, which combined with continuing surprisingly robust non-biofuel demand suggests that average daily use of soybean oil will bounce back from April and get stronger through the end of the year. The last couple of times I've shown this chart, I think I've talked about September as kind of the residual month, and that tick up in September is actually just a function of one of the series kind of being a little too optimistic on demand. And so I went through it before I put the chart in the presentation today, and that's actually not what's going on here. So really the increase over the balance of the marketing year is a function of that rise in renewable diesel demand. And so, and then the continuation of strong non-biofuel demand. And so I would expect that the next time you see this chart, it will probably be the combined demand will probably be flatter. But I don't know exactly how much we're going to end up taking out of renewable diesel feedstock demand just yet. You know, I think we are probably a couple billion pounds above where USDA is currently. I don't know that I probably will adjust it down that much, but there's a fair chance that we could see a substantial reduction in our prediction for renewable diesel feedstock demand over the balance of the 22-23 marketing year. And that would reduce total use and provide some relief on price pressure, to the extent that we have price pressure from the less than optimal growing conditions, at least currently. I put this in just to kind of show where we actually are on soybean oil futures and where we have been. So you can see that compared to last year, we're down really significantly. But we are at the, or getting close to the lower end of where I think the range is going to be. And I think while a lot of last year's price movement was driven by sentiment and speculative activity, if you just kind of compare where we are this year with where we were last year, it does suggest that there is room to run to the upside if the weather doesn't improve. And I'm not suggesting that soybean oil prices are going to go back to 70 cents even, but you could get a quick run up to 60 cents if we get into the first week or two of July and it hasn't rained much in June, and the forecast through the middle to end of July is still warm and dry. I think by the time we get there, we probably would have done a lot of that work already, but it could, given the size of the decline that we've seen over the last year, people could start to get excited about soybean oil again. I don't think that they would get as excited as they were last year because the unknown of renewable diesel demand isn't quite as unknown anymore. And to the extent that it's been realized, it's probably been realized as weaker than expected. So you're going to have that will limit the upside price risk. However, I think that given the weather outlook and as far the size of the declines that we've seen over the last year, it wouldn't necessarily surprise me if you got a sharp short covering rally, which we've already kind of started. But if that didn't continue to grow in the summer, of course, if it's dry, prices are going to go up. Okay, so despite the weather outlook and everything I've just said, this is still our forecast. Right now, we still assume normal weather through the balance of the summer and basically record soybean production. And so our soybean forecast looks very similar, with prices falling relatively sharply during the summer as the market removes weather risk premium. If again, and this is stating the obvious, but if the weather continues in the trend that it's in right now, this will relatively quickly shift back to flat and then to higher, probably over the next month. I would say by the time we get to the next month, if it's not raining, this will start to look like it's going up into the right. Okay, so despite the fact that we've had the huge decline in soybean oil futures, we've also had a huge decline in soybean oil cash prices, but the decline has been a little smaller than it has been in futures. And in particular, over the last couple of months, and in fact, in January, really, we've seen the bottoming of the refining margin, and that's helped support RBD basis levels, and to the point where RBD basis is actually positive for 2023. And soybean oil prices, soybean oil futures are not, they're strongly negative. And it seems like the robust non-biofuel demand is really kind of starting to almost crowd out some of the biofuel demand. With stocks at 2.5 billion pounds, that's not really true. The stocks numbers are a little bit old, and so things could have tightened up since then, but it's not like we're going to fall from 2.5 billion pounds to 1.5 billion pounds in a month or two. And so this is an early, I think this is a little bit of an early call, and we'll have to see what happens over the next couple of months. It may just be that what we've seen in non-biofuel demand, which if you look at the data from USDA's fats and oils report, actually implied that non-biofuel demand slowed in April, but it still remained relatively strong. And if you look at April over history, or the last 10 years anyway, it tends to be the third smallest month of consumption out of all the months. And so, one, it's not necessarily surprising that it declined in April. Two, it didn't fall below the billion-pound level. And while the difference between £1 billion and 950 million pounds is only 50 million pounds, the billion-pound level is kind of at least psychologically significant for the market. But like I said, that kind of all is in the rearview mirror. And if you talk about what's going on today, it does feel like supplies are a little bit tight, which again is a little surprising given the stocks levels. But the basis prices are actually reflecting this as well. And we've seen RBD basis actually rise about 2 cents over the last couple of weeks. So I think that there is a chance that if everything falls into the right place or the wrong place, depending on which side of the table you sit on, that you could see soybean oil prices and more broadly fats and grease prices, cash prices hold up better than you see in the soybean oil futures market. The futures market will ultimately catch up. And by that, I kind of mean, if we do have normal weather, I would expect that futures probably will continue to fall a little bit more than cash prices, and basis will continue to rise through the end of the year. Now, there could come a time in the fourth quarter or the first quarter where supplies get really tight. If this trend in non-biofuel continues and renewable diesel demand is closer to my forecast right now than whatever I turn it into later, you could get a situation where supplies do really get tight, and then basis would be significantly higher. I don't know if I think basis will reach the levels that we saw last year during the fourth quarter or the first quarter, but I think that the upside risk for basis for RBD in particular is substantially larger than the downside risk, at least as long as the weather continues its current trend. If the weather turns around tomorrow and it starts to rain in the Midwest and rains all weekend, then I would almost say the opposite. But otherwise, I would say that we probably are headed into stronger basis for RBD. And the result of that is that the forecast for RBD is not quite as down and to the right as soybean oil, and we get kind of a similar look for crude degummed. Crude degummed is a little bit closer to soybean oil futures than RBD, simply because we are predicting that the refining margin will expand a little bit. The refining margin has come back and is not as wide as it was at the peak, obviously, but is back above the 10-cent level. I'm struggling to remember exactly where it is right now, but I think back above the 10-cent level. And if you look at it just from kind of a trading chart perspective, there were two levels of support on the way down, 10 cents and 7 cents. Ultimately, the refining margin bounced off 7 cents, and working up back above 10 cents is important from a sort of a market psychology standpoint, although it's not quite the same as however many eyes are focused on soybean oil futures charts. So you don't get quite the same impact, but there did seem to be some support around the 10-cent level and obviously the 7-cent level. All right, with that, let's look at margins and the other forecasts for the past week. share my screen again, because Joao's been teasing me about not sharing my screen last time. Never gonna live that down. All right, so you can see that our outlook for margins has changed slightly. A lot of that has to do with a shift in our outlook for energy prices. Over the weekend, Saudi Arabia announced another 1 million barrel a day cut in production. The market opened like $3 higher, I think, and then just went straight down and actually finished the day lower yesterday, I believe, and then ran down to test $70 a barrel this morning before starting to recover. It doesn't suggest to me that that energy prices are headed higher in the short term. Certainly not in sort of the next couple of months. And that combined with our outlook for feedstock prices, which while the outlook for soybean oil futures is really sharply lower, or the continuation of the recent trend, I guess I should say, the outlook for cash prices and the outlook for fats and greases is closer to the outlook for cash prices for soybean oil, which is flatter than our outlook for futures. And so you get this combination of kind of steady, maybe modestly higher feedstock costs and lower energy prices, and that has weighed on our margin forecast. And you can see here that credit values aren't really helping. The LCFS credit remains around $85, which is a lot better than it had been, but it seems to have kind of stalled a little bit around this level. We'll see it. I think it did this a little bit lower, and I would expect that, again, kind of going into next year and the potential changes that CARB is going to make, that the LCFS credit probably will continue to find support. At the very least, it's probably not going to go down a whole lot in the through the end of 2024 anyway. RIN prices, on the other hand, will be much more a function of feedstock costs. And so right now we've got RIN prices kind of declining with feedstock costs. However, as we go forward, RIN prices could turn around if we get a dry summer and soybean oil prices really start to rally in the summer. And that doesn't look quite right. I don't think we're predicting the exact same price for both of those. So D6 there should probably be $1 or 142. All right, and finally, LCFS credit prices. Like I said, we seem to have stalled out maybe a little bit around 85. This chart doesn't show it that well. We have prices kind of gradually going higher over the next year. All right, with that, I will open it up for any questions. And if we don't have any questions, then we're basically almost finished on the within the time that we actually scheduled for this, which is the first in a while. All right, well, thank you everybody for attending this week. I hope to see you next week, and next week I won't look like I'm a disembodied head floating on a black background. I'll actually have my background back. All right, thanks everybody. See you next week. Bye-bye.